everyone. Do you hear me well? Yeah, okay, hi. Super nice to meet you. I'm Sébastien, I'm a partner at Serena. I know it's the last talk of the day, so I will try to keep it short as I can, as it's cocktail time just after. So at Serena, we are an investment fund. We raised a total of 1 billion euros, mainly dedicated to early stage tech. We invested mainly in France, but all over Europe and in the US. We had the honor to work with companies such as Dataiku, Electra, Descartes Underwriting, which is our companies that became leader in the industries. And we love SaaS from day one. So super happy to take this moment with all of you. When we prepared this talk, B2B Rocks told me, okay, everyone is talking about capital efficiency, but what does it mean? So we will focus on capital efficiency, and we will use what we call the European SaaS benchmarks that I launched 4 years ago. To give you a little of context, we launched the European SaaS benchmark 4 years ago. A lot of US funds made a great job to compare SaaS metrics, but with benchmark, but it was mainly focusing on late-stage companies, public companies, or US companies. That's why I decided to launch the equivalent, but focusing on early stage, so from 0 to 25 million euros in ARR, and focusing on Europe. It's the fourth edition. We did not have yet published the results, so it will be the first time that I will show the figures. And we did it on a sample of 1,000 companies all over Europe, so mainly in France, UK, Germany, and the south of Europe. So to monitor the capital efficiency, I will share with you today the framework we use at Serena. It's based on 5 metrics. The first one is the year-over-year growth rate. So growth rate is really important indicator as it allows entrepreneurs and VCs to understand how you're validating your product market fit as an entrepreneur, but how you're gaining market share and how you're taking more share a long time. If we compare the metrics of what we call best in class, and maybe a few words about what we call best in class. Best in class is companies in the top quartile of the sample we interviewed. When we take a look at best in class, companies from 0 to 5 million in ARR, it was quite stable if we compare last year and this year. And very young companies show still an impressive growth in the early stage with 225% growth for companies with less than 1 million in ARR and 128% for companies from 1 to 5 million. However, for 5 million and plus in ARR, there will be a strong drop within the growth rate, mainly for enterprise company, as enterprise budget has been cut in the last 20 months. The second metric we love to take a look at is the Rule of 40. So the Rule of 40 is super important to balance the growth with the EBITDA margin. It's a great indicator to understand the financial health of a SaaS. Over the last 2 years, more and more entrepreneurs are looking at the Rule of 40. 3, 4, 5 years ago, non-entrepreneur told me, okay, I measure this metric. Now they all spend a lot of time on it. If we take a look at 5 to 10 million euros ARR, it has been declined from 36% to 32%. And for 10 million and plus, it has been decreased from 59% to 38%. And it will mainly driven by the growth rate impacted. The third metric is burn multiple. I love this one because it's super simple. It's when you want to sign €1 in new ARR, how much you need to burn to sign this euro. So I will take an example. If I burn 1 million euros to sign 0.5 million, my burn multiple is 2x. So it's quite normal when you're building your product, your technology, your go-to-market to have a burn multiple above 1 to 3x. However, when you try to scale the company and try to get profitable, you try to get as close as you can to 1x. And if we compare last year and this year, very early companies are more efficient. However, when we take a look at 10 million and plus, it's more complicated for them. And it's from 1.1x to 1.9. I personally love this metric, net retention rate, because I think it's the beauty of SaaS business model. So to take an example, the net retention rate of 120%, for example, it means that when you acquire €1 in new ARR, it will be worth 1.2 euro the 1 year after. Why it's so powerful? If you don't sign any new customer and you have a net retention rate of 120%, you will double your ARR every 5 years. If you have a net retention rate of 110%, you will double your ARR every 8 years. If you have a 100% net retention rate, you will stay flat without new customers. So it's super, super powerful. And when we compare last year and this year, we saw that it has been, we don't see it, but there is a strong decline between last year and this year. It's in median, it went from 120%, which is considered as best in class for enterprise SaaS, to 110% in median. Last metric, it's the ARR per employee. This one is super simple. It's a great metric to align all your company, your board, your C-level, your head of, your employees. Everyone can be aligned on this metric. When you're building your company, building your product, building your technology, it's okay to be between 0 to 100K in ARR per employee. Yeah. When you're building your sales machine, your go-to-market, it's good to be 100 and 200K. And when you're trying to get profitable, a good threshold is between 200 and 300K. Thanks. And if we compare companies from 0 to 5 million in ARR, they are quite more efficient than last year. So this is a framework of capital efficiency that we take a look at with a focus on top quartile. Any question on this? No, I move forward, okay. So now, let's talk about valuation, because a lot of entrepreneurs ask me, okay, what are the market in terms of valuation, in terms of amount raised by entrepreneurs? So I will share with you the insight we get from this study. We splitted the figures by stage. So if we take a look at the Series B and Series C stage, we thought that there is a decline in valuation. However, amount raised have been increased. If we now take a look at Series A, it's quite stable when we compare to last year. It's between 5 to 15 million euro raised, with a valuation between 10 and 30 million euros. And when we take a look at seed, it was quite increased when we compare it to last year. The total equity raise last year was around 1 million euros in median. This year it's more 2.5, so 2.5x increase. So be careful with the valuation and amount raised, because right now the market is quite uncertain. So it's super hard to compare with other companies, especially with the hype with Gen AI. And I decided to make a focus on Gen AI and AI first company. And when we take a look at AI first companies, the valuation and amount raised are quite different. For example, when we take a look at bottom quartile rounds of Gen AI and AI first company compared to non-AI companies, it's 3x higher for AI companies than non-AI companies. So strong difference. When we take a look at the median, it's quite the same for AI and non-AI companies. When we now take a look at valuation are 30% higher for AI first companies than non-AI first company at the same stage. So strong difference between the AI market and the non-AI market. So to conclude, a few highlights of the discussion we had today. First, there is a shift on the market from growth at all cost to efficient growth. We see a stability in the early stage growth. Companies with 0.5 million ARR have maintained strong growth, while more mature companies have a growth rate declining. Net retention rate has been impacted. The rule of 40 is quite hard to maintain in the context of the ARR growth is declining and net retention rate declining. And the equity story is to be considered depending on the stage of the company. For seed and Series A is quite the same as the year before. However, for Series B and plus amount, you can raise money, but the valuation have been dropped. And we don't see the last point, so it will be focusing on AI and the difference between AI rounds and non-AI rounds, with AI companies raising 30% more than non-AI companies with a higher valuation for the bottom quartile. So thank you very much, and feel free to ask me any question or to grab a coffee right after.
Does anyone have any questions? Okay.
Hi, thank you very much. You said that you love really much the NR KPI.
I will get back to it.
Yeah, that one. And as you said, it's really the beauty of SaaS. What would be your advice to SaaS companies to improve the NR, on what they should work on?
It depends on the customer you target. Are you more focusing on enterprise or SMB? Oh, okay. Okay. Enterprise market is quite hard right now because a lot of corporates are have frozen budgets, so they take time to decide to take a new solution, and they take time to expand within a solution. So it's quite challenging for them. While the SMB market, it's quite stable, and we don't see it in the numbers, but it's quite different behavior between SMB and enterprise market. A great way to improve net retention rate is to take it into account as early as you can, because in the past, a lot of companies were thinking of NRR only when they were 5, 8, 10, 15 million euros in ARR. So think about it as early as you can. The second advice would be evaluate your ROI as early as you can and share it with your customer, because a lot of SaaS companies forgot to share ROI with their customer. So the customer, when he needs to renew, he doesn't know, okay, this solution, is it a must-have? Should we keep it? And at this time, it's super hard to convince if you did not have anticipate this trend or this question.
Hi. First row.
Oh, okay.
Hi.
Hi.
Hi. Thanks for the talk. I'm a tech founder in a SaaS B2B company, more in the deer type of SaaS product, and we're targeting mid-markets. We're under 1 year old, And right now we've done a lot of cold calls, sales-led generated, founder-led, and we're looking at a self-service product as well. So I was just wondering if it was maybe too early to defocus and go on to a mix of SLG and PLG or not, and happy to have your take on this.
Super hard to work both on PLG and SLG at the same time. What I see on the market, a great best practice is to start SLG to understand what your customers want. And when you understand what your customer want and the pain they face, switch to a PLG model. But the other side is quite complicated to build, because you need to recruit sales, build an account-based marketing for sales, SDR, etc. And it's quite different from PLG. It's quite different in terms of funnel. It's quite different in terms of metrics you follow. It's quite different in terms of sales funnel. So hard to execute both at the same time. Does it answer your question?
Any other questions? Anybody? Going once, going twice, going 3 times. Okay. Oh.
Can you show again the other slides when you were talking about NRR? There was another one.
This one?
Yes. Yes. Thank you.
Easy to answer this one. It was the beauty of the SaaS business model I was talking about. But not so easy to execute.
Hi there. Have you got a view on what sort of metric thresholds that VCs and Ps are looking for across those different metrics that you show?
For which stage?
Series A through to C.
I just use the equity story slide. When you're at seed stage, it's mainly a topic of team. So will the VC believe in the team to build a product on this market and maybe build a leader on this category? When you're at Series A, it's super hard to give you a revenue or a real metric, because it's more, okay, am I convinced that there is a product market fit and you're the strong team to accelerate on this product market fit? Metrics will be very considered at Series B and plus. At Series B, what we see is a range of ARR between 5 and 8 million in ARR to raise a Series B, at a growth from 40 to 80% if we take a look at the range bottom quartile to top quartile. At Series C, it will be more an ARR between 10 and 20 million euros and rounds of 30 to 70 million euros.
Sorry, just a secondary question. What are your thoughts around focusing on pricing and packaging and the impact that that has on your efficiency metrics?
It could have a great impact on net retention rate, because a lot of NRR comes from pricing. A lot of entrepreneurs don't think of increasing their pricing, but it has a strong impact on net retention rate. And you can A/B test your pricing to increase both your new ARR and your NRR.
Okay, can we give Sébastien a big round of applause?
Thanks.